Let's bring in someone who spent over 2 decades working for the New York Fed, Dino Kos. Currently, he's managing director and head of equities at Hamiltonian Associates. Dino, welcome to the show. Thanks for joining us. When I read the ECB story this morning, although we knew it was coming, there were so many questions. Why can the ECB do this when we can't? Do they have cojones, or are they doing the wrong thing? Is it because of the Fed's dual mandate? Is it because the Fed is more susceptible to political pressure? What do you make of this whole situation?
Look, the dual mandate versus the single mandate is a key component in here. And then second of all, they really in Europe truly believe that you should look at headline inflation. You shouldn't be stripping things out because they happen to be inconvenient. So there are some different perspectives. That's one thing. The other thing
is it because inflation is so hard on their memories? I mean, a lot of Germans involved in the ECB. They had the hyperinflation that we always love to talk about.
Well, I mean, that's a factor for Germany in particular, but it's not. It's less of a factor for other countries. The other thing is, your colleague mentioned second round effects, and in the Fed the Fed really believes that these second round effects will not happen. That energy will be transient. It'll be temporary, and it'll come back down. Now, we did have a similar episode in 2008. Remember, when oil went up to $140, the ECB did raise rates at that point. The Fed kept on easing and cutting rates throughout all of 2008. Of course, the ECB then had to reverse when the crisis came along. So, if anything, that'll sort of reinforce the Fed's view that if history repeats itself, that these will prove transitory. Now, whether they're right is a separate question.
And that's so interesting. Liam Dalton, who we just had on, he said he thinks the ECB has it all wrong and that they're going to have to undo what they've done.
On the other hand, Alan Meltzer says, look, we had higher oil prices going into the Middle East, going into Japan. I mean...
Yeah. Listen, Alan Meltzer I think he's onto something in the sense that, I don't see any reasons to think that these higher oil prices will be transient. That is, it isn't like a single event like 91 with the invasion of Kuwait, where, you could have an event, a military intervention, boom, oil prices come back down. In this case, we're going to have to live with higher oil prices for a while.
Longer term, the trend, supply demand, it's just going to mean higher oil prices.
It's going to mean higher oil prices, and that feeds back to the U.S. consumer because gasoline prices are so important, both from a CPI perspective, but also from a psychological perspective. And when gas prices go up very, very quickly, there is this negative effect on consumer confidence that begins to hit after a while.
We know it takes a while once the Fed starts raising rates for it really to take effect. Is it a couple of years or so? But it takes a while.
Long and variable lags is the term.
Exactly. So should the Fed start soon raising rates in your
Jeffrey Lacker said maybe by the end of the year it's a possibility.
That's very unlikely. The Fed leadership is fairly dovish. They've made that clear over the last few weeks and months.
But they are divided right now.
They are divided, but again, I'm looking at the leadership and I'm looking at where the center of the committee is. And the center of the committee, I think, is willing to let the QE2 end on time in June and then sort of see what happens. Now, I think that when I look at the horizon on a 6 to 9 month period, it's going to get very interesting because oil and gasoline prices are going to be sapping the consumer as the year goes along. State and local government they're tightening their finances, which means either higher interest rates or sort of less government services. Bad for the consumer. Then you're going to have QE2 ending in the middle of the year.
Everybody, right?
And then at the beginning of next year, let's not forget that a lot of these tax cuts that were temporary all go back to normal at the beginning of the year. So by the time we get to the fall, the talk will be about upcoming tighter fiscal policy. It's going to be a very interesting fall, and the Fed's going to be under some scrutiny as to how it'll counteract those pressures.
You expect the Fed to sort of stay on course here with QE2. What do you think about the possibility of QE3? Because a lot of people have said that's becoming more likely.
Well, let's look back at history. So we have a case study. What happened with QE1? QE1 ended at the end of March 2010. The Fed started talking about exit strategies, and then we had one soggy quarter. Q2 of 2010 was very soft, and suddenly 4.5 months after the Fed finished QE1, it was already buying securities again and signaling QE2. So that sort of tells me that they're going to be pragmatic and flexible, and that if the economy has has a soggy period, a so-called soft patch, that you could have the Fed once again come back and buy more securities. Now, I'm not making a forecast.
Right.
All I'm saying is that if the economy gets soft enough, that is a possibility.
But I mean, when do investors get weaned off of QE too? I mean, it's certainly expected. I mean, a lot of folks that come on here expect more quantitative easing by the Fed, and they said, don't fight the market. I mean, it's going to flow into all different asset classes. I mean, when can we ultimately expect it to be weaned off? Or is now?
Do we have to wait for a new Fed chairman?
Well, is the Fed policy now forever going forward when it gets a little rough? They're going to inject stimulus.
They have themselves, in a situation where the markets have now been trained to believe that the Fed is going to be operating through the asset market channel. That is through the wealth effect. So that when the economy gets soft, one way to get the economy to rise is to sort of increase asset prices through securities purchases. The consumer feels better, spends more, and the economy does better. And investors are not getting used to that rhythm, and it is a hard thing to extract it yourself from. And how they're going to do it, there's no easy answers, because as soon as the economy gets soft, investors will expect that response.
But as someone who advises investors on what to do, Dino, then do you expect that this policy is around now forever?
Well, no, forever is a very long time. So no, I wouldn't go that far. But I mean, I think there will be a communications challenge by the Fed to wean investors off of this. That will not be an easy task. So I think you're asking just exactly the right question. And if you look at it not in terms of a 3 or 6 month perspective, but a 3, 4, 5 year perspective, that's going to be important, because the unemployment rate is almost 9%, 8.8%. You need to have 250,000 jobs a month for years to bring the unemployment rate back down to something in the 5% range. And whenever that decline stops, or even if there's a brief backup, then investors are going to expect the Fed to do something about it. And so they are in a difficult position.
So wait, are you saying, wait. So are you saying quantitative easing we could see in and out for the next 3 to 5 years?
I am. What I'm saying is that investors are going to be anticipating securities purchases when they see soft patches. Now, whether they get it or not is a separate question. But I mean, having kind of introduced this additional tool, in addition to traditional tools like the Fed funds rate, now how do you say, okay, well, we're going to put this back in the closet and never use it again, having it been so prominent now for almost 3 years. It's not 2.5 years since they started using this.
So Mark Faber, maybe not so crazy with QE 26.
I wonder, and if you look 100 years from now, maybe we see, but the question is what pushes us in the other direction. And Meltzer's history of the Fed, he points out that there was a time at the beginning of the 70s when we thought the Fed can fight unemployment as long as it wants, because you can't have high unemployment and high inflation. Now then, obviously, we had double-digit inflation, and Paul Volcker had to come in and raise interest rates by a heck of a lot. Well, do we have to see real, strong, seriously damaging inflation without housing prices rising before they do anything?
The 1970s proved you can have high unemployment and high inflation. So hopefully, I think the Fed has learned that lesson, that it can happen. And if you do have a breakdown of the so-called output gap analysis, then I think the Fed will have to shift gears. The last couple of years, both ends of the dual mandate were saying you have to ease more. Well, what happens when the two are sending conflicting signals? We may get there soon if inflation begins to rise. The rest of the world, as your previous guest alluded to, and as some others alluded to, we do have higher inflation in the emerging markets. We have higher inflation in the UK. We have higher inflation in Euroland. Here, not yet. But if we begin to join the rest of the world, then the pressure will be on the Fed to do something. It's going to put them into a very tight box.
We say 20 seconds. So what do you tell investors to do quickly?
I like those parts of the world where like German exporters, where policy is they will benefit from an easier monetary policy. So I like things like German exporters. And ironically enough, U.S. equities may not be a terrible place either, because if you do expect that liquidity will stay abundant.
All right. You can call Dino up at Hamiltonian Associates for the rest of the answers to that question. Former New York Fed worker, economist, employee.
2 decades at the Fed.